Hello, everybody. Thank you so much for tuning in. Today is Thursday and it is sun shining outside, so that makes me very happy, as you all know. So today is an interesting one because I actually received this article from a client of mine who has turned into a friend and a person that I just talk to regularly about the market. And just where things are, where we see things going, watching rates, watching, what the Fed is doing, just kind of going all over the board. And I love having a sounding board of somebody that is not in the business because sometimes I realize that me being in this for 18 years now and watching the ebbs and flows, I kind of have an expectation. And sometimes hearing it from somebody who is not in the business, who is not living this and breathing this all day, every day, and hearing it from a perspective of somebody that is outside looking in, really helps me to gain perspective. So I love having these conversations. And he shared this article with me, and I have to say it was a little bit shocking because I talk to my lender, Tyler, regularly about different things that are going on in the lending world because, contrary to what most people believe, realtors do not have all of the inside scoop of what lenders do. We, obviously keep up with what we see going on and we talk to them regularly, but they'll kind of get a little bit of information about what's coming down the pipe as far as rates and things like that a little bit before we do. That's why it's so important for a realtor to have a trusted lender. And the hard thing about lenders is there are a bazillion of them. Your bank has mortgage lenders. Your credit union has mortgage lenders. If you are a veteran, you can go through that. There are also smaller entities that have lenders. So for me personally, and I've been asked this a million times, why do I choose to go with a smaller local lender compared to something that's online, like Better, or going with like a Wells Fargo or a Bank of America? For me personally, working in this business again for the last 18 years, I've worked with every single entity as far as mortgage that you can think of. And for me, I have had the best customer service with the local lender because all they do is lending. That's literally all he does all day long is lending. And he has an in-house underwriter, which means if I need something right now, like we're supposed to close tomorrow and something's not right, he can walk out of his office, walk into the office next to him, talk to her, and then walk back in his office and everything's done. When you deal with a larger bank or any of the larger entities, unfortunately, everybody has their department. So if I need something right now, well, first I've got to call that 1-800 number and get to that person. Then they've got to get to the other person. So all of that to say, I trust my lender very, very, very much. And I have these conversations regularly with him. And so we had actually talked a little bit about the article that I'm about to share with you previously, just for the simple fact there were bits and pieces of this that had come out before in terms of some of the things that were going to change for mortgage originations coming down the pipe. But some of that got pushed. So I want to just kind of dive in deep today and talk about all of this because it is a little bit concerning, to be quite honest with you, especially from a realtor standpoint, watching what the market is already playing out and doing and how much it's changed over the last 2.5, 3 years. And now they're adding this in. It is interesting. But first and foremost, tell me where you guys are joining from today. I sincerely appreciate everybody that jumps on and watches the channel. You have no idea how much when you participate and you ask questions, there are always people that text me later and say, oh my gosh, I had that same question, but I was scared. I didn't want to say anything. So make sure that if you have a question or you have a thought, chime in. You are welcome to make comments, ask questions. I always want to, just have everybody jumping in. So that being said, I'm going to share this article with you guys here. Let's, make it big. Let's see what's going on. So how the U.S. is subsidizing high-risk homebuyers at the cost of those with good credit. So right off the bat, I have to say that I'm pointing like you guys can see me, right? I saw that this was from the New York Post. And not that I'm a political person, don't want to get into politics here, but anytime I see something from the New York Post or CNN or MSN, any of them, I take it with a grain of salt because the news these days is all about the fear factor. I don't feel like they're ever going to be truthful with us ever again in our lives. I feel like the news, the more fearful it is, the more ratings they're going to get. And so for that factor, they're going to give you as much fear as they possibly can. And the other side to that fear factor is everything is national. So everything that you're seeing on the news is going to be national news. That isn't talking about your specific area, your specific location. So a lot of times it's just not the exact truth. Like they've talked about home prices coming down. Well, that's national. That's not us right here because we actually have not had a lot of housing prices going down. So in this article, it's very interesting because they talk about Fannie Mae and Freddie Mac will enact changes to fees known as loan level price adjustments on May 1st that will affect mortgages originating at private banks nationwide. The result, according to industry pros, pricier monthly mortgage payments for most homebuyers, an ugly surprise for those who work for years to build their credit only to face higher costs than expected. So let's break that down because what does this really mean for you specifically? It's a scary time because I dove into this and I did a lot of research. Anthony 20 from Take Care Pickup Line. I love it. Dedication, my man. Carl, hey, how you doing? Andres, nice to see you. Love everybody jumping on. So what does this really mean? Well, everybody understands right now that affordability is basically null and void. Prices have gotten so high the last couple of years due to inflation, and it just we got catapulted into it in 2020, and prices have just never let off. Now they rose rates, I think really anticipating that if they rose rates that prices would kind of come down, and in some areas that has happened. Places like Texas, Idaho, California, some of those places, they have seen that happen. However, here in Georgia, that hasn't happened a lot. So we have seen a little bit of a decrease only in certain areas, but we're at like 1 to 3%, which is not substantial because we rose over 20% the last couple of years. So 1 to 3% does not do anything in regards to affordability. Now, if you look at the flip side of that, rates going up and home prices not coming down, that just made affordability even less affordable. Like there is such a problem here with home prices and rates continuing to rise. So what they are saying here in the Biden administration is trying to make those that have good credit scores, because if you have a good credit score, and when I say a good credit score, I'm specifically meaning a 680 and higher for a loan origination. If you're coming in with a 680 or higher, that is considered a pretty strong credit score and you're going to get a better rate. Now, if you have a 680 and I come in with a 640, you're definitely going to get a better rate than I am. And I'm going to end up paying for that lower rate. I'm going to have the higher interest rate, which means I'm going to have a higher monthly payment. And sometimes the origination fees are a little bit higher as well. So just to keep in mind, I took some notes from my lender because I was asking him a ton of questions, and I'm actually going to have him on here in a couple of weeks. So if you tune in, you can ask any mortgage questions, lending questions that you have. But for every 20 points on your credit, the rate goes up. So even going from a 680 to a 660, your credit, your mortgage rate is going to increase, going down just 20 points. So keep that in mind. So when we're looking at this, if I have a 640, somebody else has a 680, they're going to get a better rate than me. So now If you're looking at putting 15 or 20% down, where that's always been looked upon as something that's great. If you put 20% or more down, then you are eliminating PMI, private mortgage insurance. Now, again, I don't mean to get political, but y'all, the facts are the facts. And you can agree with me, you cannot agree with me. Totally your call, but facts are facts. And looking at this, it very much feels like they are punishing those that have tried to do a good job, that have tried, because let's sit here and think about this. A 3% down payment on a home is a substantial amount of money. On just a $300,000 house, that's close to $10,000. So let's say that for years, you've saved a little bit each month, or every year when you've gotten your tax returns, you've put that aside because you know that you're saving for a down payment on a house. And so now you're putting that chunk of change down and you're being punished because you saved. You're being punished because you were responsible with your payments every month on your car and on your credit card and on anything else that you did to build your credit, your rent. You're being punished because somebody else didn't keep their credit score up. Somebody else didn't save. And so now they have more to pay. And so it's going to be less affordable for them. So now you're going to be charged a penalty fee that is going to help it make it more affordable for them. So if you put down 20%, you're being punished. Why? Why? That's the question. My opinion, and it's solely an opinion, however, I feel like it's facts, so you can agree or disagree. But my opinion is the PMI, the private mortgage insurance, well, that's going to their pockets, is going to the lender's pockets. And you might not know this, but back in 2008, Fannie Mae and Freddie Mac, which are two of the largest lending organizations, were bought out by none other than our government. And so what happens with that? Well, they need their money. If you put more than 20% down, how are they going to get their PMI paid? You're paying it off. It's like, if you buy a car outright, well, then they don't like that. They really don't want you to buy the car in cash because they like the fact that you're paying the interest. It's the same thing here. So don't sit here and be fooled. Now, I will say that this is supposed to take place on May 1st. And there has been a massive uprising. Right here, you can see it's going to be a challenge trying to explain to somebody that says, I worked my whole life for high credit and I've put a lot of money down, and you're telling me that's a negative now. That's a hard conversation to have. And this came from a mortgage loan originator. It's unprecedented. My email is full from mortgage companies and CEOs telling me how unbelievably shocked they are by this move. So the thing of it is, mortgage originators, mortgage lenders, as well as realtors have come out and said, what in God's creation are you doing? We're already in a volatile situation as far as the market goes because interest rates jumped. Interest rates are not horrible right now. I don't care what anybody says, they're not horrible. When they cross over 10%, we'll talk about horrible. But right now, they're back to a relatively normal rate. I think we were at 4 to 5% for many, many years. We're at 6.5 right now. I do think we'll get back to 7. I don't care what they say. I think the hard part for people right now is that we keep doing this. There's no stability, right? If they would just get to a point and leave it there for a little bit, people could at least expect what their payment is going to be. When one day it's 7%, then the next day it's 6.25, then it's back up to 6.75. People's monthly payment is changing every day, and they can't justify what price point am I at because you change it on me every single day. Hey, Joe Haley. Let's see. This is so painful to hear, especially after you work so hard to be debt-free and save. I agree with you 100%. Is it possible to have PMI removed with the value of homes going up recently in our area? Girl, 100%. And we're going to talk about that. So that is one of the things that I want to make sure that we talk about, because I sent an article out a couple weeks ago on the newsletter. If you don't already get the newsletter, You can sign up. Just shoot me an email, ashley@myhaventeam.com. I just try to keep you guys up to date on what's local in the area. Also, any articles like this, because PMI is something that definitely can be removed. We're going to come back to that. I promise I won't forget. So with this article that we're sitting here looking at right now, it says the tweaks could further complicate the strenuous mortgage application process and add more pressure on a core segment of buyers in a housing market already in the midst of a major downturn. Right now, rates are at 6.27%. Under the new rules, high credit buyers with scores ranging from 680 to 780 will see a spike in their mortgage costs, with applicants who place 15 to 20% down experience the biggest increase in fees. This was a blatant and significant cut of fees for the highest risk borrowers and a clear increase in much better quality borrowers. Why? Why are they doing this? Especially when rates have already gone up, the market is volatile. So, it's just one of those things where with risk comes adjustment. And so when you have people that are higher risk, they're going to get higher fees. And so now they're trying to make affordability more of an option for those people, but at the cost of people that have saved, like Joe Haley just said, that have saved, that have been debt free, that have money to put down. So it's very frustrating. And I wanted to put up this one here. Give me just a second. Let's take a look at. So Biden to punish good credit homebuyers to subsidize high risk mortgages. The fee, which will be those buying or refinancing after May 1st on a home loan of $400 or more. So this is something that's so frustrating. The changes do not make sense. Penalizing borrowers with larger down payments and credit scores will not go over well. I'm all for the first-time homebuyer having a chance to get into the market, but it's clear these decisions aren't being made by folks that understand the entire mortgage process. Because the fact of the matter is, the lender is going to be the one that has to make these that are going to have these discussions with borrowers. They're the ones that are going to have to explain why. Great, I'm glad that you have 15% down and you've done a great job with your credit. However, unfortunately, we have some new fees that you're going to have to pay. And a lot of times what people don't understand is the lenders have to kind of get into the process with you, pulling your credit, going ahead and doing all of this before they can give you a well-versed, qualification of what your mortgage is going to look like and what your rate is going to look like. That's why I always tell people, get pre-qualified ahead of time, submit your documents, have them run your credit. I hear so many times, oh, I don't want to run my credit because, it's going to ding me. Okay, but now you're getting into the process. You think you're buying a $500,000 house. And then when they get into it and you finally submit all of your documents and you look at your credit score, you realize you can't afford that $500,000 house. You can really only do $450,000. So now we're back to the drawing board, and the house that you fell in love with, you can't have because you can't afford it. So it's really important to go ahead and have these conversations up front. Now, do I think that there is a possibility that this is going to be pushed off? I absolutely do. And I'll tell you why. Because the National Association of Realtors, or you'll hear it NAR, they have come out fist ablazing, full swing to let the government know that this is not okay. Like, this is not how we make borrowers that don't qualify as high. This is not how we make homes more affordable to them. We are all for affordability and getting first-time home buyers into things. And it's not only first-time home buyers, it's a lot of people, but this is not the path to take. And mortgage lenders, they have come out stating that, this is not okay. This is not how we need to change things, especially in the market that we're in. So it will be interesting to see how things play out, because one of the other points that I wanted to show, going back to this one over here, and this is one of the ones, sorry guys, technology at its finest here, trying to get this up. FIFO delays implementation of the LLPA DTI fees. So this is one that my lender Tyler and I were talking about, because again, with risk comes adjustments. And this is something that they were trying to put into place with people that have a higher debt to income ratio. They were trying to, the upfront pricing fee on ratios of 40% or more, part of a larger series of changes to the enterprise's pricing grids, was slated to go into effect on May 1st. However, that has since been postponed to August 1st. And so what this is saying is that if you have a higher debt to income ratio than 40%, so basically, let's say you make a certain amount of money. If what you bring home, your mortgage is over 40% of what you bring home, then your debt to income DTI is off. They want to see your DTI, debt to income, your car payment, your insurance payments, your house payment, school loans, although sometimes those can be deferred. But if they're active, if you have credit cards, you owe child support, alimony, any of those things are considered in that debt to income ratio. And they want to see your debt to income ratios at 40% or below. You guys, I'm sorry, but that's smart. That's smart. So now what they're looking at is if you get to higher than that, let's say 50%, they would accept you. Right now, a lot of times you'll be, you won't be given a mortgage if your debt to incomes are above that, or you'll have to buy a home that is a little bit less. So let's say you were trying to get approved for 500,000. Looking at your debt to incomes, unfortunately, you only are going to qualify for 300,000. So with this, they're saying that they would allow you to go up to 50% debt to income DTI, but you're going to be charged a penalty fee because, again, with risk comes adjustment. You're a higher risk. You're at 50% DTI. So now we'll allow you to do that. However, you're going to have to pay a penalty for that because we as the lender, or they as the lender, not me, they as a lender are taking you on as a risk. So it used to be 45% right now as the DTI. That was the max that you could go to. It has gone up to 50%, but that's where this is coming into play, saying if you're going to be at that threshold, if you're going to be at that max, then you're going to have to pay a penalty fee because the lender is taking on a huge amount of risk. So right here, this is one of the things that I was appreciating my lender talking to me about because I was really trying to wrap my brain around it, right? So if you have a 760 credit score, but you are at 30% DTI, or somebody else has a 780 credit score, but they're at 50% DTI. The person at the lower credit score of 760 with only 30% is a lower risk than the person that is at a 780, but with a 50% DTI. Because realistically, credit score only takes you so far. If I'm maxing out my credit cards, my car payment, I'm spending as much money as I can, and I'm at 50% of what I make each month, I'm putting out. That's a huge risk because what happens if I lose my job? What happens if my next paycheck doesn't come in? I can't make my mortgage, right? And so with that being said, that's one of the things that you have to consider. Anthony, will these additional costs be included as overall costs, closing costs? And if so, could they be covered by the seller as part of negotiations? That is a fantastic question. And we don't have an answer yet. They have, since it didn't get pushed through, we don't know exactly where it's going to fall. We believe that it would be part of it. And we believe that that's something that could possibly be covered as closing costs. But then the factor still rolls into what if you have money to put down? So a lot of people, what we've been talking about, and one of the things that I was talking to my lender about was, let's just say, Anthony, you're buying a house. And so if we put that money, just say you put 5% down because you don't want to be punished for putting 15 to 20%. If you put down 5%, can you then immediately after you close go in and put additional monies down, or would you be penalized for that? Because some people have a loan where you can actually be penalized for paying the loan off early. Now, most of the time that doesn't happen any longer, but if you have one of those loans and you went in and immediately put down additional monies, would you be penalized? That's a question that we don't have an answer to yet. And hopefully we'll be able to find that out more. So Joe Haley, I want to go back to your question here. Is it possible to have PMI removed with the value of homes going up recently in our area? The answer is yes, because with your PMI, private mortgage insurance, you have to have 20% into your home. Now, you could put that 20% down as a down payment, or once you gain enough equity, so let's say that your home was worth $300,000 when you bought it, now it has gone up and it's worth $450,000 because of inflation over the last couple of years. Well, you very much have gained at least 20% equity in the property. So, what you have to do is you call your lender, whoever holds your mortgage, you call them and say, I have 20% equity in my home. And they'll usually ask you, what is, how do you know, or what does that look like? And you can show them that other properties, and you can reach out to me if you want to get this, but I can send you a CMA that shows other properties in our neighborhood are selling at 450,000. We bought it at 300,000. They can even pull the tax record or the tax assessment to see what the county is valuing your property at. And if you have 20%, then you can go ahead and knock off that PMI. Now, where this gets tricky is each mortgage company is different. Some of them will just knock it off, and literally your next payment will not reflect PMI anymore, which usually is a couple $100s. So it could be a massive savings. However, some companies, some lending companies will not just take it up. You have to actually go through a refinance to refinance without that PMI on there. Mine personally was that way. I had to do a refi in order to get my PMI off of my loan. And so I had to really look at that, because then now I'm paying the refinance charge. You can roll that in. And for me, it made financial sense to go ahead and refinance, because my closing costs for my refinance were going to be like $2,000. I could roll that back in, or I could just pay it up front. I paid it up front because at the end of the year, I was paying about that $2,000 anyways in private mortgage insurance and PMI. And this was going to be for the life of the loan. And so I might as well go ahead and pay that fee and get the private mortgage insurance off. So if you have questions specifically on do you think that you could get the PMI off, call me or shoot me an email. I can do a CMA to see where your value is right now compared to when you purchased the property. And it very well could be something that you could be saving on. Is there some kind of calculator homeowners can use to estimate a possible new mortgage payment? So thankfully, this is not going to reflect on people that already own a home. This is going to be on origination fees moving forward. So Joe Haley, you bought your house last year. You're sitting pretty, you're doing fine. If you were to sell your property, or like you said, your family was thinking about moving, they would be looking at the possibility of these fees. They have been pushed off until August. So that's a good thing. Will they stick? I don't know. When we get new administration, will it change? I don't know. These are all questions that I wish I had answers to. I wish I had a crystal ball that I could shake up and know. But unfortunately, we don't have answers to these questions. So it's something that we're definitely going to want to keep our eyes on. But it's going to be for people moving forward. These fees would be like origination fees and closing cost fees. That's why Anthony was asking, can it be something that you negotiate in and have the seller pay for those closing costs? However, the struggle right now is we're still in such a strong market that we're not really seeing a lot of sellers paying closing costs. The last couple of homes that I've put under contract, we've had to go over the asking price. Now, thank God it wasn't substantial. The last couple of years, making $100,000 over ask is just absolutely insane. Waiving all of the contingencies. It was crazy. And thankfully right now we are seeing contingencies put into contracts. We're seeing people get a little bit over asking. I think the most I've seen right now is 40,000. That's not to say that it couldn't be higher. That's just my personal transactions. That's what I've seen. Carl, is there a way to calculate your DTI prior to? Yes, absolutely. The first thing to do would be if you go and you literally just Google mortgage calculator, or DTI calculator, you can put in everything that you have. If you're a good financial person, you probably already have a spreadsheet, or I know there's online trackers like there's apps on your phone. Mint, I know, is one of them. There's a couple others. But if you have everything in there, or you're just looking at your statement regularly, I'll be the first one to admit I'm horrible at this, which is stupid because I'm in the industry, but I'm horrible at making sure that I know my DTI. But if you look at what credit cards do you have? Do you have any school loans that you're actively paying on? Are you paying child support? Are you paying alimony? Do you have a car payment? Anything that you have that is open that you have to pay for monthly, not groceries, not gas, but active things that they would pull on your credit, seeing what those would be. That would be a place to start on looking at your debt to income ratios, because those are your debts that you're paying each month recurring. And the thing that people don't realize is if you have a credit card, and let's say that you pay it off every single month and you only run it up to $100, but you have a $10,000 limit, that $10,000 limit is considered when you look at the fact of you have a $50,000 limit, or you have a Home Depot credit card that you never even use. It's just something that you got years ago, but it's got a $5,000 limit. That counts, because that is available credit to you. You could potentially, after you close on a home, go run up that Home Depot credit card for $5,000. So that is something that they look at as available credit to you. So don't go run out and close cards. I see people all the time. They're like, well, I'm going to pay this off and close it. No. Don't do that. Don't close anything. Don't do anything. Again, when you're looking to buy a home 6 months or more in advance, talk to a lender, because they can look at this with you and tell you what your debt to income is, what you should look at paying off, and what you should leave alone, because sometimes you need revolving credit in order to have the credit score. Now, if we're being punished for the credit score, hell, we don't know where that's going to go. But currently, do not just go paying things off and closing things, because it has a snowball effect. And I don't know if any of you guys follow Dave Ramsey. I follow him loosely because some of his things I think are genius. Some of his things I think are absolutely insane, like the fact of buying a house in cash. Well, then hell, you're going to be 60 before you can buy the house in cash. And I just think that that's not a smart thing, because your equity that you could have been making along the way would have catapulted you into the next bracket. But I got off on a tangent with Dave Ramsey there, so let's focus. Currently, if you talk to a lender ahead of time, they can actually help you dispute things that are on your credit that maybe they are yours, maybe they're not. But even if they are yours and you dispute them, a lot of times they end up falling off because it's from 10 years ago, 15 years ago. That will immediately boost your credit score. So do not pay things off. Do not close things out. Talk to the lender before you start, way before you start, so that you can work with the lender to see, what should I leave alone? What should I pay off? What would be the best course of action for me to have the best credit score that I can, and to make sure that my debt to income is realistically lower. So Carl, if you have specific questions on yours, I'm happy to talk to you with it, or I'm happy to connect you with one of my lenders. Shoot me an email and I can definitely, get you started on that. Joy Haley, oh, I see. We're good for now. Thank you so much. That's awesome. A lot of people over the last couple of years have enough equity to get the PMI off. So that's the article that I sent out a couple of weeks ago in the newsletter. And like I said, if you don't get the newsletter, Ashley@myhaventeam.com, email me. I'll make sure that you get it, because that newsletter talked about the fact that if you have enough equity, even if you didn't put 20% down, if you have enough equity, you can call your lender and get that off. And most people don't realize that they pay a couple $100s a month or more. It's dependent on what your loan amount is. It's a percentage of that. And so if you're able to get that off, it could be saving you a couple $100s a month. And I don't know about y'all, but getting our taxes last week and this week, the live last week was about our taxes, because I've had so many people reaching out about appealing their taxes because property taxes have gone up with inflation. comes higher taxes. So that's always a great thing. But I want to wrap up, make sure that everybody knows exactly what I'm referencing. So all of these things have been delayed for now. Is there a possibility that we could see these things coming back down the road? I do think that there is. I really do. It's going to depend on how much pushback the government gets. Again, I do not feel that it is a good thing that Fannie Mae and Freddie Mac are government owned. Back in the day, they were not. They were their own entity. And anytime you have government owning something that they can make money off of the people, you're always going to have greed involved. And it's a scary thing. But I went political on there and didn't mean to. So I'm going to let you guys go. I appreciate you tuning in. If you have any specific questions that I didn't cover in here, you know my email, ashley@myhaventeam.com. Email me. I'm happy to talk to you about anything, get you a CMA if it helps. So I will see you guys next Thursday.